Hello, and welcome to a special edition of Wealth Management Insights. I'm Steve Edwards, Head of Portfolio Construction and Cross-Asset Strategy here at Morgan Stanley Wealth Management. And today is Tuesday, February 3rd, and I'm recording this from my office in New York. If you're a founder or an entrepreneur building a private company, chances are you spend most of your time thinking about growth, product, talent, customers, and capital. Taxes understandably tend to come later, often much later. But today I want to talk about one acronym that deserves a place much earlier in that journey, QSBS, or Qualified Small Business Stock. QSBS sits inside Section 1202 of the Internal Revenue Code, and its purpose is simple, even if its execution is not, to reward long-term investment in small growing businesses. When structured properly, QSBS can allow founders and early investors to exclude up to $15 million of federal capital gains per taxpayer, and sometimes much more through planning when they sell their shares. That's not a rounding error. For many entrepreneurs, it's the difference between a good outcome and a transformative one. So what determines whether a stock qualifies? At a high level, the company must be a USC corporation with no more than $75 million in aggregate gross assets at the time the shares are issued. At least 80% of its assets must be used in an active qualifying business, and not all industries qualify. Financial services, hospitality, energy extraction, and a few others are excluded. From the shareholder's perspective, the rules matter just as much. Shares must be acquired at original issuance, not on the secondary market, and held long enough to qualify for exclusion. Under current law, that means partial exclusions after 3 and 4 years, and a full 100% exclusion after 5 years. What's changed recently, and why this matters now, is that the rules became more generous in 2025. The exclusion cap increased, the asset threshold expanded, and the holding period rules became more flexible. In other words, QSBS became more powerful, but also more nuanced. And nuance is where many founders run into trouble. Certain company actions can quietly disqualify QSBS eligibility, including large share redemptions, parking excess cash in illiquid investments, drifting into non-qualifying lines of business, or simply growing past the asset threshold without realizing the implications for new shares. Then there's planning on the individual side. Because QSBS is calculated per taxpayer, not per investment, some shareholders may be able to multiply the benefit through strategies known as stacking. That can involve gifting shares to non-grantor trust or family members, each of which may be entitled to its own lifetime exclusion, provided the transfers are structured correctly. Other strategies can help start the clock sooner. Early option exercises, 83B elections, and careful handling of liquidity needs can all make the difference between qualifying and missing the window. For serial entrepreneurs, there's even a potential reset button. Under certain circumstances, gains from QSBS held more than 6 months can be rolled into new QSBS eligible stock, deferring tax and preserving eligibility down the road. The common thread here is timing. QSBS is not something you fix at exit. By then, it's usually too late. It's something you design into your ownership, equity compensation, and estate planning years in advance, while the company is still private and flexible. The takeaway is not that everyone should pursue the same strategy. It's that QSBS rewards intentionality. Founders who understand the rules early and coordinate with legal, tax, and financial advisors are often well positioned to turn long-term value creation into long-term after-tax wealth. As always, these rules are complex and the stakes are high. But for entrepreneurs building something meaningful, QSBS remains one of the most powerful and most underutilized tools in the tax code. If you would like more information about all this, or if you have additional questions, please reach out to a Morgan Stanley financial advisor. Thank you.